Things are going to get scary now, though. It's Halloween tonight, so it must be time for the annual M&G Investments Bond Vigilantes roundup of the scariest charts in global finance. And when vigilantes tell you something scary, you better listen. Now, one chart that stood out to us was this one, with many companies having put refinancing off for some time now. Maturity walls are closing in. Nearly 10% of high-yield issuers face refinancing risk in the next 2 years. This has the potential to become the largest refinancing effort for high-yield issuers since the GFC, the great financial crisis, if great is appropriate. Let's talk to Andrew Eve, the author of these charts, investment specialist at M&G Investments, who brings us this horror show this morning. Andrew, thank you very much for joining us. So the percentage of high-yield bonds maturing in the next 2 years does look scary. Does it look scary to you?
It does look scary. I think we've seen now we're something like 18 months into the hiking cycles of most central banks. And one of the things that's been surprising to investors is that high-yield valuations, high-yield credit spreads have remained quite resilient. Some sell off over the past few weeks, but broadly speaking, we've seen high-yield spreads get down to some of the tightest levels that we've seen since the GFC. And yet, despite this, we've got this big maturity wall coming. I think there's a couple of reasons that credit spreads in high yield have remained quite tight. Partly there's demand from yield-hungry investors, and also there's a lack of supply because high-yield issuers, quite sensibly perhaps, have held off from issuing with borrowing costs being so high. But the other side of the coin, of course, is that with many high-yield issuers having held off from issuing bonds, we've now got maturity walls closing in. And I think this could be, as you say, one of the perhaps largest refinancing efforts for high-yield companies since the GFC.
OK.
Can I just say congratulations on getting Anna into the Halloween spirit?
I know.
Kicking and screaming.
Absolutely. Dragged, I was.
Andrew, that's an image there for everyone. Andrew, as we meditate on the fact that Anna was hauling pumpkins around last night across North London.
Oh, well.
Andrew, in terms of the high-yield risks then, is there a region where those risks are more acute than others? Is Europe at the forefront when you're thinking about the risks around high yield? Is it Asia, US? How does it stack up on a regional basis?
I think it tends to be that the US is the riskier element of the high yield complex. European issuers tend to be a little bit more defensive in terms of the sectors that we tend to see issuing within Europe. I think one of the silver linings that we see within high yield, despite that very scary chart with around 10% of high yield issuers needing to refinance, is that if you look below the numbers there, that 10% is made up largely of the double B issuers, so right at the top of the high-yield complex, the most creditworthy companies, who not only have more resilient fundamentals generally, but also perhaps face more benign refinancing costs.
Fallen angels. Sounds a bit Halloween-y, doesn't it? Let me ask you about inflation then. And you've got another scary chart for us. Let's move on to this one. Inflation, usually you say, comes in waves. And you've got a nice sort of offset of what inflation has looked like recently. And you compare it back to, you know, drum roll, the 1970s, as many people do. But does it usually repeat? Does history repeat in the way that your chart perhaps hints it might do?
Well, I think that's right. Financial markets do tend to repeat themselves. You know, history does often repeat, and I think we should look at what's happened when we're trying to think about what happens today. Now, inflation has been falling. Price pressures are clearly easing. We've seen monetary policy start to tighten, and the effect of that is coming through into the economy. But this chart really shows us that maybe we should treat that with caution. Inflation does tend to come in waves. And I think that makes sense because inflation tends to cause problems in the economy, problems for people, and that's, of course, what we're seeing at the moment. And governments naturally then try to solve those problems. And the way they do that, naturally, is to spend. I think we're in a political climate where there's not much appetite to increase taxation, and therefore, with a need to spend to solve some of these problems, presumably the only way is to issue debt. If central banks then come in and buy that, we could see money supply, which has fallen over the past couple of years as central banks have tightened rates, start to increase again. And maybe we will see a return of inflation in the more medium to long term.
Well, that brings us to financial conditions then. You've got a chart that also talks about the fact that real rates are back in positive territory and the consequences for that, if that becomes a theme longer term, as central banks talk about higher for longer. Talk to us about the potential implications as markets adjust to that new reality.
As you say, markets are adjusting to that new reality, and we have seen central banks now manage to get conditions a lot tighter. We know that monetary policy tends to act with a lag, usually 12 to 18 months. And while central banks have been tightening for some time, it's only around now that perhaps we're beginning to see the full effects of that coming through into the economy. Now, what that scary chart shows is real rates. So we've calculated that there as the Fed funds rate minus core PCE, so the Fed's favoured inflation measure. And if we look through history, what we tend to see is when that measure gets above around 3%, that tends to be a precursor to recessions. Financial conditions are then sufficiently tight to start slowing the economy. And if we look at the charts now, what we see is, based on the annualised data, the real rate having now reached 2%. But if we look at the 3-month PCE annualised, so more recent inflation dynamics, we see that actually we've got to above 3%, so a very scary chart for financial conditions.
Scary, but I suppose some people might argue it means the Fed could do some cutting if the horror show did transpire.